Hello and welcome to another episode of Darwin Investors. Got a big show planned for today, but before we get into it, you're looking for a quick monkeypox play? Don't worry about it. Your boy's got your back. Apparently there's a company here called Cpi, and they use compassionate treatment for monkeypox cases. Their stock, though, unfortunately, has already made its run, and so you might be a little late. My advice is don't invest in Cpi. All right, so got a huge show planned for today. I'm kind of excited to bring this to you. I want to go into like who's buying the dip right now, and then I'll show just excerpts of a real quick video from Mike Wilson of Morgan Stanley. He's their chief investment officer. He's known as the biggest bear on Wall Street, and give you some thoughts about what he's getting into. Though he's the biggest bear, he does make some good points, and you always have to keep, consider both sides of the story. And then after that, I'm going to talk about this week's biggest events that are upcoming. We got the Apple World Developer Conference. You got AMD is going to have their Financial Analyst Day, and the huge one on Friday, which is going to be the CPI read. And this market's it moves a lot based on news. And CPI, nothing is bigger than inflation news in today's market. So we'll talk about that, and I'll give you a little bit of analysis from my take. And then next, I'll go ahead and talk about my options portfolio update. How did I get in? Did I get out of my last week's options that were looking not that good? Did I get out of them at a loss? Did I do it a win? Did I roll them? What did I do? And we'll talk about my options update. And then I got a small video from Glenn Kelman. He's the Redfin CEO. And we'll talk about what he sees for the housing market going forward. Now, this guy's been the CEO since like 2004. He knows the housing industry really well, and he might be able to provide you a little bit of insight, whether it's now a good time to sell your home, hold on to your home. Is your home price going to decline, or is it going to remain about the same, or is it going to go up? And he's going to give his insight into that in this small video. And then if nothing else, if you just can't take all the other topics, make sure you go clear the end, because Ggpi has got a lot of news out there. I'm a value investor at the moment. The second this market turns and the Fed decides that they're going to reverse course and bring interest rates back down again, and growth stocks start flying, I'll get back in those kind of stocks again. I'll be the first guy in line. Well, maybe not the first, but one of the first to go buy flying cars. I don't know, EHang, Joby Aviation. I don't care. I'm go where the money is, and that's why I'm Darwin Investors. But right now, I'm totally in value. But despite that, there is one SPAC that I really like. It's Ggpi. They're the company that's going to be bringing Polestar public. And so if you do nothing else, make sure you stick around for that. All right, so I came across this article, and freaking kudos to young investors. Here's who is and isn't buying the stock market dip. And really, this could carry on to all retail investors. We're not the ones selling out here. And so what it says is, according to the recent Bankrate survey, younger investors are far more likely than their older cohorts to take advantage of the economic turbulence and increase their investments this year. That is great. We are in a fear market. Fear is when you should be investing. I think Warren Buffett's been saying that, I believe, for like 400 years, maybe 500. I don't know. He's been saying it for a long time. And definitely, this is the market you want to be investing into. You want to invest into like some crazy, exuberant type of market. This is when you want to do it. More than 43% of Gen Z investors, that would be age 18 to 25, there, I just learned something. I didn't know that was Gen Z. And over 27% of millennials aged 26 to 41 plan to invest more this year than last year, compared to the 18% and 14% who plan to invest less. These younger cohorts are investing more. Gen Xers, of which I am one, shows that only 14% and 8% of baby boomers plan to supplement their investments in 2022, compared to 16 and 22% who plan to invest less. And that's understandable. If you're getting into retirement type age, you're probably thinking, well, now's not the time for me to invest in something that I hope is going to grow in the next 20 years or what have you. And again, they go on to talk about who's buying the dip. And here we are. Yeah, Warren Buffett suggests selling when everyone else is buying and buying when everyone else is selling. Buying now is a good option. They go and they talk about these I bonds. If you have $10,000 or less to invest this year, it's worth considering nearly risk-free I bonds to score a 9% interest rate. And that's because it's an inflation-based bond. And since inflation is high, this is the bond to buy. You can't really buy it through your brokerage. You have to go through the Treasury Department's website, and it's got a maximum of $10,000 each year. But this is a good option for someone who's got $10,000 looking to make a guaranteed 9%. But the bottom line here is that when the market falls, it's generally advised that investors stay the course. Keeping your money invested prevents you from missing out on future potential gains. Apparently, this has been drilled into younger investors to the point where they live by this, and they put their money where their mouth is, and like, kudos to those investors. Now we'll go ahead and look at this video from Mike Wilson and see what he has to say. He does make some good points, but he does get a little bit out there. He starts talking about trading, he'll say 16 times the price to earnings index, 17 times, 14 times. So let's go ahead and do a quick review so we understand the words coming out of his mouth. And so right now the S&P is 4108. That's the level at which it stands. If you look over here at Yardini, this is where I get, where anyone can go out and get all of their PE ratios and their latest market data. This came out on June 4th, 2022. And this would be the daily. Let's go ahead and look at the weekly. And the weekly says that we're currently trading at 17.6. So when they say the market is trading at 17 times or 16 times, this is what they're referring to. Right now, large cap stocks are trading at 17.6. Mid caps are trading at 12.7. You can see that's some of the most historically low levels that we've ever been at. And small caps might actually be at an all-time low. So small cap S&P 600 stocks are trading at 12.3 times. If you really want to make now I'm looking at this, now I'm thinking about it. If you really want to make a sneaky play into, say, a recessionary type of high inflation environment, it looks like investing in small cap value would be a really good move to make. They're trading incredibly cheap right now. As a matter of fact, that gives me an idea for another video. I'll probably get into some small cap value stocks, not small cap growth, small cap value, companies that have lower market caps that are trading at very reasonable, and some might even say very cheap price to earnings ratios that might be being overlooked because they're small cap or mid cap stocks, especially if they're going to pay a nice dividend on top of that. These might be the area we're getting into, but that's not what Mike Wilson's going to talk about in this video. What he's referring to, and what any analyst on television refers to, as large cap stocks. And he says right now we're trading at 17.6 times. Like I said, the S&P 500 is sitting at 4108. The way that you calculate this is you go 4108 and you divide that by 17.6. That gives you a metaphorical earnings per share of $233.40. Now, what it'll say is that, let's say you want to trade, instead of at 17.6 times, you want to trade at 16 times. So let's say let's go 16.5. At 16.5 times, now your S&P 500 is trading at 38.51. And so when they're talking about market multiples that are 16.5 times or 17 times, that's what they're referring to. They take the S&P 500, divide it by the price to earnings, it gives you a number, and then when they say 16, they re-multiply that number just the way we did on that calculator, gets us to 3,800. All right, so let's watch that video a little bit from Mike Wilson.
More in the markets with Wall Street's biggest bear, definitely one who is against consensus. Mike Wilson is Morgan Stanley's chief U.S. equity strategist and CIO. Although you're getting more company day after day, Mike, you think that we're in the middle of a bear market rally? We could actually see 5% higher here. 3,900, though, is your end target. What does it look like from now to end of year?
Yeah, thanks, Melissa. It's good to see you all. And yeah, I mean, the crowd is moving in the right direction. And that is, I would say, a necessary condition for a bottom, but not sufficient. And what I mean by that is, the market is forward thinking. And so, valuations have come down in anticipation of two things: the Fed hiking, and then, of course, earnings revisions to the downside. I think, our bearish call this year people agreed with the Fed part of it, but were really pretty adamantly opposed to earnings risk. And I'd say the biggest change in the last 6 weeks is that now more clients are coming into the view that earnings going to come down. So this is the cat and mouse game. Multiples will lead again. So yes, I'm very much in the camp that this rally will fade, 4,200, maybe 4,300 if it can, go a couple more weeks. But fair value is about 3,800, which means in order to give me some upside, I've got to see it trade below that. And that's why we think we will trade sort of 34, 3,500 sometime in the third quarter. And then we would get aggressive at that level to be adding to risk. But right here, the risk reward is poor. It's obviously worse than it was 2 weeks ago after this rally.
Hey, Mike, it's Tim. Semis are up 6% last month. So if anything, some of the most cyclical stuff actually has had a pretty decent rally. But I'd like to ask you about just the retail factor and flows. And some part of your job is at least to understand where positioning is. We had 80 billion come in through retail investors in the last 3 months, the same as the 80 billion that more or less came in the three previous months. As awful as it's felt, we actually haven't seen it. And that's actually bearish to me. We haven't seen any reversal of some of these flows. How do you feel about that?
Yeah, I agree with that, Tim. We've been writing about this quite a bit with help from our colleagues in the trading platform, basically suggesting what you just said, which is effectively, the asset manager community, the active traders, they've de-risked quite a bit, but the asset owner community, including retail and individuals, that community has not sold yet. And let's not forget they put in over $1 trillion in 2021 post the vaccine. So absolutely, we think we will see that group fade and distribute stock and take some profits and hunker down a bit when the numbers come down. And that has, that's the part I think that people will be fooled on, because sentiment is bearish, but we haven't seen the negative flows yet from the asset owner community.
How should we think about valuations, Mike? A lot of people out there, they will cite a benchmark S&P forward PE ratio of 16 is something like the historic. But should we think about that as being a benchmark in that maybe we swung too far to the upside when times were good, and we should be expecting a swing to the downside on the other side?
Valuation is always tricky. So we have a framework that tries to incorporate both rates and then an equity risk premium, because then you can say, okay, which side of this is out of whack? And right now, obviously rates have gone up a lot this year, but we think rates are sort of fair at 275, 285, given what the Fed's doing, where the economy is. Where we think stocks are too expensive is in the equity risk premium. Today, after the rally last week or so, we're back below 300 basis points on an equity risk premium. We're at 285, and our fair value market multiple would imply 350 on equity risk premium, which would take your multiple down below 16 times. And I would argue, quite frankly, that if, given the risk in, geopolitics and the economy, there's a potential, recession next year, the equity risk premium should probably be closer to 400. And that would mean 14 and a half times, which is basically the overshoot we need to get you to 34, 3,500. So we're pretty disciplined in that, but, I'm not going to lie to anyone. I'm not going to pretend that we have precision on it, but that's the framework that, tells us the risk reward is poor.
And though Mike Wilson is considered the biggest bear on Wall Street, he does bring up some good points. I do think there is going to be, and already it's been shown, a lot of value compression. I don't think it's going to happen to the extent that he says at like S&P 3,400, 3,500. But I don't know that that ending the year at 3,900 is completely out of the question. We just want to make sure that in the meantime that we're in good quality companies, we're accumulating shares, that we're selling covered calls against our underlying, and that we're getting nice dividends. There are still companies out there that you can invest in, at least for now. And some of those companies are going to be a lot of your energy companies. And I'm not saying stay in these things forever, but man, you can stay in these things while they were hot. Heck, we were in SPACs and that sort of thing for a while. So why not oil companies while the going, is really nice? Some of the more popular oil companies would be Pioneer, Diamondback Energy, and Devon Energy. And which one might be a nice one to get a little bit of returns on and get some dividends while we wait for this thing to turn around and the Fed to lower interest rates? Well, you can see that Pioneer over the last year is up 63%. It's got a very attractive price to earnings ratio and forward price to earnings ratio. However, its dividend is kind of lacking at 1.12%. Pioneer has got a profit margin of 20%, which is nice, and a growth forecast of 17.4%. That's also really nice. Looks like right next to it here, Occidental Petroleum. Their dividend is really low. Their earnings per share is forecast is going to grow really nicely at 23.5, and their net profit margin is outstanding. Next one that we'll look at really quick that you might be able to get into is Diamondback Energy. Diamondback Energy is up 77% over the past year. They have an attractive price to earnings ratio, much cheaper than that of Pioneer. If I had to decide between Pioneer or Diamondback, I would definitely go with FANG. I would go with Diamondback Energy. Their annual dividend yield is even a little bit better than Pioneer's. And their profit margin's huge, man, 35%. That's a very Microsoftian profit margin there. So the government might have something to say about this, but for now, go ahead and let's see. Let's go ahead and take advantage of this. Their growth forecast is about 16.4%. So Diamondback Energy is one to at least go in and look at for now. All of these you should keep an eye on. A profit margin like that for an oil company when so many people depend on it is something that you definitely want to keep an eye on. It's not going to be going to the moon. Okay, and then last we'll go ahead and we'll look here at Devon Energy. Devon Energy is my preferred choice. Over the last year, it's up 149%. It was actually the best stock in the S&P 500 for the year of 2021. And here in 2022, it's still up 69%. And the reason why I like this stock so much is it's got a very attractive price to earnings ratio. It's got a very nice forward PE, but best of all, it's got this 6.6% annual dividend. So Devon Energy is my pick for this sector. It's got a net profit margin of 25, and it's got a growth forecast of roughly 20. And this is the sort of thing that I would be looking at today. And then sell covered calls if you're going to do it, pretty far out of the money, because this thing is actually it's running right now. So what's on tap for this week? So Apple this week is going to be holding from June 6th to June 10th their Developers Worldwide Conference, and they're going to be talking about technology and community. And then you get a first look at Apple's latest platforms and technologies and sessions, and they'll explore the newest tools and tips and that sort of thing, connect with Apple experts. Apple's one of the companies that I think might get a little bit squeezed in this particular market environment, or at least this macroeconomic environment. And the reason is because they are not a low-end retailer like a Dollar General or a Dollar Tree, nor are they a high-end retailer like, say, Lululemon or Toll Brothers Homes or any of these like high-end retailer type of companies. What they are is they're kind of a mid-market retailer. And that is the people that are getting squeezed right now. And so I worry a little bit about Apple, though this week might be a good week for them if they hold a really nice conference. And that's happening on Monday through Friday. There's not too much going on Tuesday, but then on Wednesday, here's an opportunity that I'm going to probably take to make a little bit of money. And on Wednesday, Five Below reports their earnings. They report their results after the market closes on Wednesday. And so this is a discount retailer. And so discount retailers have been doing well this earnings season. Dollar General did well, Dollar Tree did well, TJ Maxx did well. TJ Maxx did well on Target's earnings because they're like, oh, you got to send your stuff somewhere. So these discount retailers are doing fine. And why are they doing fine? Well, they're doing fine because our unemployment rate is really low. And though we might be squeezing out the middle class, we're expanding another consumer base, and it seems to be the one that tailors to this Five Below cohort here. So what I do then is you go over here, and this is the only time I'll ever look at technical indicators, by the way, and I'll look for a good place for like support and resistance. And you can see this stock is way down. It was $207 a share way back in January, and so from there it shrank 45% or so to the bottom, about $93 a share. Since then, it's gone back up another 15%. That's probably because they have earnings coming on Wednesday. But we can see that a good basis, a support base here would be about $115. Once you have a good support here, then you go over to your Schwab here, and this is what I'm going to do is Schwab. and I go to 5 below, and then I sell a put. And we'll go over what selling a put means. I'll give it a expiration date of June 10th, and we'll give it a strike price of $115 because that seems to be a really nice line of support. Because of I'm selling a put, then I'm going to go ahead and I see the midpoint here is 107 or $1.75 a share. Each contract is 100 shares. It means someone is going to pay me $175 to hold this contract for them. And so what I'm saying is that if 5 below finishes below $115 by June 10th, I'm on the hook to buy 100 shares of 5 below at $115. If 5 below finishes above $115, I keep the $175 and the other person has to keep their shares. And that's what it means to sell a put. Selling a put's a bullish play. Puts are often thought to be bearish, and if you're buying them, they are bearish. But if you're selling them, they're bullish. You think they're going to finish above a price. Now, I'm not going to do this first thing on Monday, not unless the market has completely gone through the floor. I won't be doing this on Monday. Remember, they report on Wednesday after the market closes. So a good time to then sell your put would be after this is done. It's like declining thing. Let's say that by Wednesday morning, this is at like $5. Then I would be able to sell one for roughly the same price with a strike of like $95. And so you want to wait. You want to wait until the end, and then after they report their earnings. You don't necessarily want to wait all the way until Friday to collect all 175 because, anything can happen. And in this market, you gotta make sure to take your small gains. And so what I would generally do is just kind of close this out at like, I don't know, if I've made like $100. Let me see if I've actually even traded a 5 below put at any time. I've never bought their shares. Let me see if I've ever done a put on them. I have. Yeah. So it looks like I have. On March 29th, I sold it to open, and the next day I bought it to close. Looks like I sold it for $128. I bought it back for $60 and it made $67. So that'd be the sort of thing I'm looking to do now. I would probably sell it for $175, hoping to make about $85, $90. And it's just a real quick way to go into the market, grab your money and get out. And then make sure you're selling these things way out of the money so you can get a little bit. Then on Thursday, AMD is going to have their Financial Analyst Day. And Financial Analyst Day, they're just going to be talking about their numbers, and they're not really going to talk about any big product things. It's not like some big developer conference like the one Apple's having on Monday. I don't expect this to move the market much. But if these analysts are come out and they're super bullish about the future financial stability or whatever the future of AMD finance, it's going to have a pretty nice impact on NVIDIA, on Semi, maybe Intel, just different semiconductor companies. So this could actually boost the market on that day, though I don't think that's what's going to boost the market on this day. I think what could possibly boost the market on this day is people closing their short positions, because what they're going to want to do is they're going to want to close their positions before the big event, which happens on Friday. And on Friday, what we have is the CPI release. The CPI data is scheduled to be released on June 10th at 8:30 a.m. Nothing is moving this market like inflation data. And so when we look at what is expected here, inflation, as you can see, was running up in a straight line month after month, October, November, December, January, and so on and so on. And then it peaked at 8.5. Last month, it was at 8.3. If you're looking for a reason why the market might have had a bad week or like a bad Friday last week, well, the reason why is because they're not expecting inflation to come down. Last month, it was 8.3. The forecast this month is for 8.3. And so we're not expecting inflation to come down at this time. When you look at, say, year over year inflation data, and this is here from the Bureau of Labor and Statistics, they released their CPI data, you can see that many of the big numbers that we're seeing here year over year, some of these huge numbers, 80% for fuel, 43% for gasoline, 44% for commodities, 30% for energy, 22% for utilities and gas. You know, you have to expect that inflation is going to come down at some point just because this is unsustainable. You just can't have 80% increase in fuel every single year. That just isn't going to happen. And that's why I'm a little bit leery of some of these fuel stocks, a lot of these oil stocks, is the run they're on has been absolutely epic by their standards. Bad for us, great for them. But we can't expect that to continue for the next 2 or 3 years. At some point, this has to calm down. And so and for that reason, inflation in general is going to come down at some point. But the point is that they're not expecting that point to be next month. They're expecting that to actually be even from last month. If this read on Friday morning is 8.6% or 8.4%, or just if it goes up and it shows that we're not an inflection point coming down, the market's going to absolutely go through the floor. If the market shows a surprise and we go to say 8.1%, or even, like, it would be nice, like 7.9%, and we get back to a level that we were back here in March, or was that February? We get back to a level back here in February, then the market's really gonna take off on Friday, and that remains to be seen. So what we're hoping for is a much lower inflation read. Their forecast is very pedestrian. It's just like they're saying it's going to be even month over month. So last week I put out a video showing my covered call positions. And we can see that I was down at the time, $639.40. This would have been last Saturday on all of my positions. And what does that mean? So let's just give a quick recap. So the easiest one here would be JP Morgan. If by yesterday it finished below $133 a share, I would get to keep $43. If I wanted to close it out, say last Friday, it would have cost me $92 to close it out. And same with NVIDIA. It would have cost me $119.50 to close out something where they gave me $50. All the way on down the line where I would have been down to $639. My point for this one was the market went up very unexpectedly. Like, we didn't expect the market to go all the way up, and it did. And it did so on very bad news. And they're like, the thought was, well, if the market goes up this high on bad news, we've priced anything in, we're like ready for the next bull market rally. And so a lot of people holding onto these contracts are going to lose money. Now, I was only going to lose $639, but think about if you're like a huge hedge fund, like a Goldman Sachs or Morgan Stanley or whatever, they're holding on to huge losses because they're short in the market, especially Morgan Stanley. And so they're going to have to unwind their shorts. Well, unwinding their shorts drives the market up. Every time you cover one of these, we're all familiar with short squeezes. Every time you cover one, it makes the market go higher. It makes the stock price go higher. And so that's called the short squeeze. And so let's go ahead and see how I ended up doing last week. So we look at here from May 30th until June 3rd, we can see that I was able to unwind my shorts for a gain of $66.60. So I didn't actually lose any money last week. And what I did was I was able to, and remember, I was doing it as a basket. I didn't care if I lost on some and made money on others, just so long as I finished positive. I just needed to unwind and not lose money in the end. That was the point of this. And it was the reason for some of the funny market play last week. And like I said, I feel like I'm kind of like some sort of like little mini barometer of what like big hedge funds are doing, because I'm playing the same game they're playing. And so what I did was I kind of like trade out the whole basket and try not to lose. So though I lost on AMD here, I won on JP Morgan, won on Lowe's, won on Microsoft, won on NVIDIA, and lost on UPS. But at the end of the day, I ended up making $66. Now, a couple of these that I closed out, I closed this out on the second, the second, the second, the second, the second, and the second. So what I was doing was I closed it out for really close to zero, because in a market like, you don't want to get too greedy. When these markets are tough and it's tough to make that extra buck, just do not get greedy. Do not go for everything, or I'll show you what can happen. So So what happened was I closed them on the second. I opened up another one on Microsoft. I opened up another one on NVIDIA. And it looks like I made $33 on NVIDIA and I made $28 on Microsoft. So about 61 bucks. So I ended up netting about $5 on all of those trades. Now, $5 doesn't seem like much, but if you're down $650, making $5 is a pretty, you'll take that. You just want to get out of it. So the two that I actually lost on money on last week would have been AMD and UPS. But if I had held on to those trades, AMD, if it closed out on yesterday under $104 or over $104, I'd have to sell 100 shares for $104. Well, how did AMD do? AMD finished at $106, so I would have lost all those shares. And then the other one that I lost on would have been UPS. If it finished above 182.50, I would have to sell 100 shares yesterday for 182.50. How did they do? Well, they were 185.49. So you see how I was able to make $5 and I lost a little money here on my underlying, but I still made money. I made $5 overall, and I got to keep these shares and got to keep these shares. And then I'll show you what I did with these shares afterwards. Why would UPS have had such a good week? Look at this. UPS on what was a bad week was up 3.83%. We're talking about up 3.83%, and it's a PE ratio of 15 and a dividend yield of 3.28. This is a fantastic stock right now. It's a great stock because I look at it as one of those consumer staples like a Microsoft, like a Google, like a Kroger. I think that you don't have a lot of choice. You've got to send it UPS or FedEx. And for that reason, but one of the reasons why it was up was because Lululemon reported this past week. They reported on June 2nd, and they recorded just fantastic results. But one of the things that they can't cut back on because it's their consumer staple is due to the supply chain, they have to use air freight, and there's not a lot of choices for Lululemon. And because analysts are looking at this, well, they got to look at air freight. A lot of other companies are going to have to use air freight. They can't use ships. Air freight remains challenging. Now the costs are high. Those are probably going to come in a little bit. Lulu might pressure UPS and FedEx, but it's tough to do because you don't have a lot of choices. And so for that, UPS was up last week, and they pay a nice dividend. Well, I was able to roll my options. After I closed it out for $5 gain, I was able to roll them up in time, or up in the money and out in time. And now, if AMD closes this Friday over $118, I have to sell everything for $118. I sold that for 51 bucks. Same with UPS. Now it's up over $190. I rolled that one up in price and out in time a week, and someone paid me $48. And now this one, I sell it at $190. If it goes over that, let's say if it's $192, I have to sell it for $190. But what does this mean for the broader market? And this is the thing that makes me think that unless there's a lot of positive news that comes out of this Apple week, or unless we get really good inflation data, we could be headed for a little bit of a tougher week. And I'm going to show you why options wise. So for the past month or so, it looks like I'm up about $767 on options, mostly winners. But we're going to have a really good look at AMD and why would things not necessarily pop up right now in the market this week? Well, let's take a look at my AMD position. You can see that between February 15th and today, I bought AMD and sold it a lot. My cost basis on AMD is $115.60. I have 100 shares, and this was the cost basis, so $115.60. If you include my options in this and the money that I've made off of AMD just trading options, my cost basis now, because I've made money all along the way, taking little dividends in the form of selling covered calls, my cost basis now for AMD is $111.85. Now remember, my covered call position on AMD is $118. So if I let it go for $118 and my cost basis is $111, I've made money. So I don't care if I lose these 100 shares for 118 because my cost basis is only 111. And so there's not going to be this desperate play for me to cover this short to get out of this position like it was back when it was $104, because I was going to lose $700 and now I'm going to make $700. Now you put this on a grand scale like from Goldman Sachs or Morgan Stanley or JP Morgan, and now we're talking about moving the market, right? If you're going to close all these positions, you're going to move the market. They're not going to be interested in closing these positions because they're already winning. Now let's take a look at, say, UPS at 190. So I was originally assigned UPS at $195 on April 11th. And so my cost basis here was $195. Now, if I include all my options on this between those days, my cost basis on UPS goes from $195. Now remember, I'm selling covered calls. And remember, I actually even lost $56 on the last covered call for UPS. But my new cost basis for UPS is $191.82. Now remember, I'm selling a covered call for $190 now. So I might have to let go of UPS for $190 plus this $48, so it'd be $190.48, and lose roughly $100 on the deal. Now, though I don't want to lose $100 on this stock overall, I'm not going to close this out if it's some huge, gigantic number. I'm not closing it out. I'm just going to go ahead and let it roll. And so there's no reason for me to roll UPS up in price and out in time. And so UPS might suffer a little bit. So my point in illustrating all this is that there's not going to be this huge sense of urgency to close out these positions because they're really not going to losing any money, and they're actually going to be making money in some cases. So I wouldn't expect the market to go up due to short squeezes during this week like it did the previous week when the market went up unexpectedly and we had all of our shorts in play. Next, we'll take a quick look at a short video from Glenn Kelman. He's the CEO of Redfin, and kind of give you an idea of where your house price might be going, at least in his view. And the guy does know what he's talking about. But I think it's interesting because it's actually what I felt like I was going to do in my own life. I just feel like if we look at our own lives, Peter Lynch used to say, go to a company if you like the company and they're trading at a reasonable price and they make good cash flow, then go ahead. That might be a good company for you to go ahead and buy. And so I feel like that you can actually take a look at your own life and kind of think about what might be a direction that the economy might be headed in or something like that. In the case of housing, it seems like that I might have it kind of correct, at least according to Glenn Kelman. So let's take a look at this video.
Glenn, always good to see you.
Good to see you.
And you're smiling even though it looks like the housing market is slowing. Tell me, Glenn, in 6 months, is the market going to be better or worse?
Probably the same. Rates
Why?
are probably going to 6%. Inventory is increasing. Sales volume will be somewhat fine, but prices are going to soften.
So prices will soften. So therefore, you're going to make it more affordable, basically. So you're going to make up on the hike in mortgage rates. How about the dynamic, though, of people who have to sell their homes in order to buy another home? Why, if I have 3.5% or 3.25% now, the thought of paying 6% for a bigger house is really tough.
That's where the market is really going to be pinched. So many people are locked into the home they're living in now by a 30-year, 3.5% mortgage. So they're going to stay in that property forever. Maybe they will rent it out. But if they actually want to move up, they are going to have a hard time affording the next place. If you combine interest rates with what's happened to home prices over the past year, the mortgage payment for a median price home in the United States is up 43%. So buyers are saying I've had enough, and sellers are starting to freak out a little bit.
And so I have to agree with them that a lot of us aren't going to sell our homes at this time and move because we don't want to pay the higher interest rate. We're locked in. And that's what I'm finding in my own life. And even if I did need to go buy another house, I'm not going to sell the one that I have now. I'm simply going to rent it because it's too good of a deal. And because I'm not going to move, one thing he didn't mention is that you might end up taking like a home equity loan to kind of perfect the things about your current home that you don't really like that much. Let's say, like my wife, she doesn't like the kitchen. She might say, hey, let's go ahead and upgrade this kitchen. And so companies like Home Depot and Lowe's, they might do really well if we're not going to sell our homes. And these are things to consider. So now, as a consumer who's sick of high gas prices, I'm about to go out and buy a Tesla. And I'm going to do this as soon as I'm done recording this video. And let me show you the cars that I was choosing between. So I decided to go with, that I'm probably going to go with the Model 3 here. And this is just a search within 50 miles of my house. So I'll have a look at this one here. It looks like I can get for about $42,000. I got another one here that I can get for $45,000. It's got 41,000 miles. But the more interesting one, and I'm still not sure, I'm not going to do this, is looking at the Polestar 2. Polestar is a newer company. It's financed. It's backed by Volvo. You can get these from a Volvo dealership. And you can see there's a lot of Polestar 2s for sale within 50 miles of my house. You can see that the price of them at like $58,000. That's a markup, by the way, from MSRP, which should be about 45 to 49. But you can see that this is a Model 3 competitor, and you can buy lots of these right now in this area. And so I might end up going one of these. One of the reasons why I didn't want to is because of they can't use Tesla superchargers. But so Ggpi is the company. It's a SPAC that's bringing Polestar public. Right now it's selling for $10.05. And I own a lot of shares of this. This is my gambler stock that's in my portfolio. I really believe in Polestar. And I know that we have a company here that Polestar is actually partnered. It's actually owned by Geely Holding Group, which is Hong Kong listed, and it's a Chinese EV company. So Volvo is owned by a Chinese company. It's a SPAC. It's an EV. It's unprofitable. And I know if you're keeping track on your scorecard at home, that would basically be garbage stock bingo. But actually, I believe in this company. And the reason why I believe in this company is because they just keep hitting their numbers. All they do is produce. So they actually did get their 29,000 cars produced and sold last year in 2021. And that's up 185% year over year when they only delivered 10,175 cars. They also recently just inked a deal here with Hertz. They have a partnership to let them purchase 65,000 EVs over the next 5 years. Now, Hertz can always back out of this if they want to, but right now it's looking like they have 65,000. They have a nice customer with Hertz where they can sell them 65,000 cars. They also have their own fast charging infrastructure that's going to come into play in the name of this company called StoreDot. So they're going to have their own supercharging facilities. They also have the Polestar 3, their EV, which is going to be coming out at the end of this year. Now, it hasn't come out yet, but every time this company says they're going to do something, they do it. And so until that stops happening, I'm going to continue to hang on to these Polestar shares because they say they're going to do it and then they do it. And then next year, there's no picture for this, but this would be the Polestar 4. This is going to be the Model Y rival. Some might say it's kind of going to be akin to, say, the Porsche Macan. And that's going to be arriving in 2023. And what is said here is the Polestar 4 will be a premium sport SUV, cost similar to the Macan. The Polestar 3 would be more like, say, your Porsche Cayenne. That's the one that's going to be coming out at the end of this year. But the Polestar 4 would be more like the Macan. And so it's going to be a competitor to the Model Y and the e-tron from Audi. And it says the Polestar 4 will be a sporty SUV coupe, more compact than the Polestar 3 with a high volume potential. It will bring driving dynamics and minimalist style to Polestar to a market segment that we believe will continue to grow. And why would it grow? Like, why would you not believe them? All they do is pull through on the things they say they're going to do. And then last but not least, on June 22nd, GGPI stock shareholders are going to vote on the Polestar merger. So GGPI will turn into PSNY on likely June 23rd, or the day after this meeting. So on that day when GGPI becomes PSNY, I would expect this stock price here to be something in the neighborhood of $16 or $17. I just feel like it's going to go up 50%. And so am I going to sell out of it at that time? No, I'm not going to sell out of it, because here's the only reason it would keep me keeping on these shares. Let's say that they don't put out the Polestar 3, or they delay it like a year, say like a Fisker does or something like that, or Lucid is always delaying. If they're one of these companies that's going to delay, yeah, I'll sell my stuff at a win. But if they continue to produce and they continue to perform and they continue to do what they're doing, and I believe they will, because Volvo's a fantastic company, I think they're going to do what they say they're going to do. And if they're going to continue to produce, I'm going to continue to holding these shares. If they put out the Polestar 3 at the end of this year, and if they pull out the Polestar 4 next year, there is no way I'm selling my Polestar shares that I bought for like $11. So that's all I got for today. So if you got anything on this video, yeah, please like, subscribe, hit that little notification bell. Until then, we'll see you next time. Have a good day. Bye. And it's funny that all of the cars that I want are actually, that at least I'm going to look for, are actually on this lot. This is a Tesla here. It's got a pretty good price. It's about $45,000 is what they're asking. And this is a 2019 Tesla. It's nice, you know, it's not it's not the Boxster, but I don't know. They'll have to offer a pretty good trade-in for this one. And then there's another couple of Teslas on this lot here too. There's this white one here. Looks like that might be a Model S. I wasn't going to look at that one. I was kind of looking more for Model 3s. The Model 3 that I want to look at is down this way. So this is a Model 3 here. So here's another 2019 Model 3. This one's actually less. This one's selling for $42,000. I kind of like the rims. It's a 2019 as well. It's going to have a little bit more mileage on it, and that's why it's a little bit less, costs a little bit less money. But that's a nice Tesla there. And then the car we're waiting for over here, this is the Polestar. The Polestar is right here, and this is the one I really want. I want that Polestar, but we'll see. I love the interior of the Polestar. It's a beautiful car. Let me see if the doors are unlocked. Yeah, the interior of the Polestar, really nice. Looks like it smells brand new. It's only got a couple thousand miles on it. So we'll see what, if anything, we end up coming home with. As luck would have it, the cubicle they set us in is right in front of the car, right in front of the box we're about to trade in. So we'll see what kind of offer they make for us. So it looks like it's out with the old. We decided we'd go ahead and get rid of the Boxster, and be sad to see this car go. It's actually the first car I've ever sold that I was kind of sad to see go. And then now I'm gonna go ahead. We got the Model S here. It's a nice Model S. Screw you, gas companies. I will be charging my vehicle from now on. And yeah, there you go. So it's a done deal. Out with the old, in with the new. Have a great week, you guys. I'll talk to you next week. Bye.